All right, John, how are you doing today?
I'm doing very well.
Excellent, excellent. So I know we'll be talking about how to tell a data-driven story regarding your business, specifically AgTech Venture. Great article series. I know we covered a few different facets there, talking about researching not only the industry but the key players, and then also from a startup perspective on exits, valuations, things along those lines. Would you mind just starting us off with a recap of the series, what was covered, and then we can dive into some questions. And then to the audience, at any point, feel free to add any questions in the Q&A, and we'll be happy to answer those along the way.
Absolutely. Perhaps the easiest way to start is to give a brief introduction of who I am and the organizations that I work with and how you and I came to be connected through this universe. Let me give you a quick recap on my background. My background is mostly technical. I spent almost 3 decades working in technology for companies like Hewlett-Packard, AT&T Bell Laboratories. I worked for a couple of startups in the Bay Area some years ago. I've got a couple of engineering degrees and a business background, so both the technology background and then the operational experiences I've had. I've worked for a number of different divisions of a global technology company, managing things like wireless network product development. I worked in product development for over a dozen years. I worked in strategic alliances and marketing, go-to-market. We were launching new products on a 4 to 6 month basis on a global around the world. And so I've traveled much, seen many industries. I've participated in a number of standards committees. So I had built over that experience an understanding of how new technologies come to market. In addition, I've been an angel investor for 10 years. In 2010, I joined a local angel investor group here in the Sacramento region called the Sacramento Angels. I've actually been on the board for the Sacramento Angels for the last 8 years, since 2012. I managed their selections process for 4 of those years before passing that on to other individuals. In selections, we look at all of the incoming pitches from startup companies. And we looked at startup pitches from companies all across Northern California, and most of the West. I personally have investments in about 20 different startup companies. I'm currently the manager designate of our investment vehicle called the Sacramento Angels LLC, where we aggregate investments from all of our investors. And so, although I haven't personally invested in every single one of those transactions over the past, I would say, year, we've made about 15 different transactions. So I'm intimately involved with transaction documents and investing, and have learned a lot through those 10 years of investing. It's an expensive education. You lose a lot of money when you are making angel investments because you're really going for those few big wins.
Yeah.
The typical economics for angel investors are over half of the investments they make yield no return at all, or don't return the cash that you put in. It's the ones that do well, that return, sometimes 7 to 10x or more on your investment, that really pay for all of the mistakes that we make.
Makes sense.
So
And I know you're in the ag space as well. So how did you get your start with AgStar? Story behind that as well.
So as part of being an angel investor and working with the startup community in the region, we had a regional technology alliance that was supporting startup companies. And we had a very strong engagement between the Sacramento Angels investor organization and this regional technology alliance. And they had a number of initiatives. Clean Start, which I know Blue Tech Valley has partnered with closely, was a part of that. In 2012, they launched a new program in the ag and food space in conjunction with the University of California, Davis. And they managed that through about a 3 or 4 year trajectory. Unfortunately, that Regional Technology Alliance went insolvent in 2016. And we felt the ag and food effort, which I'd been part of since its inception, was so important for our region and for the Central Valley that we needed to keep that going. And so I and a number of other members of the Mentor Advisor Group for AgStart formed a new nonprofit called the AgTech Innovation Alliance, focused on making AgStart successful, and we've carried that forward. And so over the past 8 years, I've invested a lot of time and effort, all on a pro bono volunteer basis, understanding California's agricultural environment, the ag tech community, and how ag tech intersects with clean tech, intersects with water technology, intersects with all of the other digital technologies that are maturing rapidly around the world, and how those can be applied in the specific vertical market of agriculture and food. We've built a big network. The organization that I'm part of now AgStart. We provide education, mentorship, and connections to startup companies in the Northern California region. We partner closely with the Wet Center there in Fresno, Blue Tech Valley, and Valley Ventures. We partner also with the Western Growers Center for Information Technology in Salinas. We have global partnerships actually with FME in the Netherlands, which is a trade industry group focused on technology and has a specific initiative in food and ag. And we've also engaged with a number of delegations from both Latin America, from Israel, from Australia, from China. Agriculture is a global industry, and innovation in agriculture is something that we're seeing happen all over the world. California, by the way, I should point out, is a significant hub for innovation in ag and food technology, driven by the innovation that's going on in California, the access to capital, and also the very high value commodities, the very high value nuts, fruit, vegetable products, fresh leafy greens that we grow here that provides a high level of margin to growers, and anything they can do to improve their yield even by 3, 5, or 10% has a significant impact on the bottom line. And so they're eager for new technology and innovation. And that's what I think makes California such a hub for innovation in ag and food technology. So getting back to the articles that we started writing, when the COVID crisis hit and we realized that a lot of our startups were suddenly sheltering in place and unable to get to their labs, unable to get to their customers, growers, quite understandably, have gotten kind of hunkered down and keeping people from visiting their farm who aren't already part of their community, who aren't either a supplier, customer, or a critical advisor on their growing operations. They're trying to protect their workforce and their workers and prevent people from getting sick. So it's made it very difficult for startups to make progress. And so we started drafting a set of articles based on the experiences that I'd had as an operational leader, as an investor, and thinking through what is it that we see most often from startup companies that they could perhaps develop more readily and take advantage of the downtime where they're sheltering in place, to take advantage of resources that were available on the web to kind of build up their story about their business. We see a lot of technology innovators coming forward who are innovators in the ag and food technology space, but their understanding, if they didn't necessarily come out of the agricultural industry, they may not necessarily have a deep understanding about how decisions actually made by growers or by food producers, what the channels of distribution are, the go-to-market for their innovation. How do you actually reach, the thousands of growers you may need to reach to make your innovation successful? It's easy to talk to 2 or 3 or 5 growers face-to-face, person-to-person, explain your value proposition, have them say, sure, I'll try one. And after, a free trial for the first growing season, the next growing season, they say, yeah, it seemed to work. I'll try another one. That's a very slow process, and that's not going to get a startup to scale. So understanding the distribution channels and go-to-market are critical for them. Being able to articulate that message of their understanding. From an investor standpoint, when we look at an entrepreneur coming to us, we're trying to assess not only does this entrepreneur have a value proposition that makes sense, but is this entrepreneur someone who understands the industry well enough to be able to get their product to their customers through the channels of distribution that exist, or build the channels if they don't exist? And do they have enough understanding of their marketplace that they can really make this successful? So in the short, 10, 15-minute investor pitch that a startup company might give to our angel investor group, we're trying to read through those slides to assess, does this entrepreneur understand the market that they're looking to serve? Do they understand the channel partners who can help them accelerate their growth, or the potential competitors who could block their growth? Do they understand who their strategic partners might be, the alliances and the partnerships that might help them take their innovation from a California starting point to a global distribution network? And do they understand the relative valuations of startup companies in their segment, in their category, at their level of maturity, so they can have an intelligent conversation with investors about valuation and potential exits and everything else? So to help those startup companies, their community, we posted on our AgStart website a set of resources, a set of articles that walked through 3 different topics. One was assessing the market that your innovation is looking to serve. And that's just taking advantage of free resources available on the web to build a better, more compelling story about the size of the market, and the structure of the market you're looking to serve. The second article looked at within that market structure of the suppliers, the partners, co-conspirators in your segment, and the customers that you're looking to serve. Who are the strategic partners, the global ag tech companies or the global equipment providers, the global channels of distribution that exist in that segment? Categorize those, be able to identify them so that if someone mentions their name, you recognize, yes, those are players in the segment that I should be concerned about, and be able to have a conversation about what are you doing to make sure that your startup company, your innovation, has visibility among the relevant strategic partners that you might want to have relationships with. Not that every one of those strategic partners will be a potential acquirer or a potential investor. They may become competitors. They may partner with one of your competitors, one of your startup innovators. But you should know who they are. And at some point, they should know who you are as a startup company. Because at the end of the day, when the investors in your company are looking to have a financial exit or liquidity, and they're looking at who potential acquirers might be, and they start listing off company names, or you tell them, here are the 5 companies that are relevant. And not only that, here are the 3 that we've had engagements with, either joint testing of our technology in their environment or joint testing of our technology as an adjunct to their own value proposition they're delivering through their channels to their customers. And here are the ones that seem most ready, willing, or needing of our solution. And that's the best benefit that we can provide. So
Sure.
those are the articles that we wrote, and I'm happy to talk through in detail any one of those.
And John, what I appreciate about your articles is it's helping startups take their presentation and their research to that next level and giving them a process to do that. So before we jump into what should you do, I'm curious, as a Sacramento angel and what you've seen, what are you typically seeing as far as the deficiencies? Are you seeing startups come in there with a lack of research? Are they doing some things right, but they're just not fulfilling this? I'm just curious. You're raising the standard to this point, but where's the standard at currently?
You know, we don't really have the knowledge to understand whether the entrepreneur has done their research. We generally want to give them the benefit of the doubt, but it's always compelling for them to demonstrate that they've done their research by showing us a quick value chain. Who are the suppliers to their segment? Who are their customers? And who are the other, what are the mix of other partners, suppliers, distribution channels, et cetera, that are relevant for their specific segment? There's always, 2 or 3 clusters. The suppliers who are providing them the materials they need to be able to deliver their value proposition, the channels they use and partners they use in delivering that value proposition, and the customers they're really trying to target. And the more specific an entrepreneur can be about, here are the initial customers we're looking to solve, here's the value proposition we're offering to them, and here are the other kind of adjacent follow-on markets that we'll address after we've penetrated this particular segment. In the ag space, it might be, we're going to look at producers of tree nuts, almonds. And the adjacent markets after that might be tree fruit and vineyards and other things. But we're first focusing on tree nuts because almonds are 1 million acres worth of production in California, and it's a huge market. And we have engagements with these 3 major growers already. So by articulating that kind of structure of the industry, here's the bowling pin model. Here's the lead pin we're going to knock down, and that's going to take us into 3 other markets after that, and additional markets after that. And here's what we're doing to attack that first pin. That articulation helps us understand, yes, this entrepreneur understands their market and has a clue as to how they're going to go about attacking that. Very frequently, we have entrepreneurs who are not that specific in terms of their approach. They may, in the back of their mind, have that's exactly their strategy, but unless they can articulate that to us quickly, it always leaves a question in our mind. And the best way to articulate that quickly is either with a word or a picture, and the phrase "a picture is worth 1,000 words" is extremely relevant, especially in a time-limited pitch in front of investors. You might have 7 to 10 minutes to make your case, and by showing a quick image that demonstrates that you understand the structure of your marketplace and who the key players are, et cetera, that can avoid 20 minutes worth of conversation. And often in that first meeting with investors or partners or other suppliers, you may not have 20 minutes to make that story.
Of course. And One of the things here, and I'll reference some questions back and forth. And for anyone that, if we go a little in depth on the subject material of the article, feel free to just reference those afterwards as well. And that could probably build upon what we're discussing today. One of the things, John, that we're seeing is, someone's done their research. They understand TAM, they understand their total market size. They've done the right segmentation. One of the feedbacks that we get here, at least at the Wet Center, is, okay, we've produced the data, but investors aren't necessarily buying the fact that we can capture this market share here. So what, from your perspective, when someone does the research on the market size, what else do you want to see some level of validity with the fact that they can actually capture that market share, or their plan will actually come to fruition?
Let me answer that in two ways. I frequently see from investor pitches from entrepreneurs, the market is $1 billion. And that might be true. Someone might say the crop protection marketplace is a $15 to $20 billion business, and we're attacking that. And we only need 1% share. But the crop protection marketplace, and this is, again, crop inputs before growers put things in the ground. This is the fungicides, the pesticides, the herbicides that they might use. Well, break it down. The crop protection market is big, but if you're providing a fungicide, narrow that down to your fungicides, maybe biological fungicides used in the crops that are relevant for who you're targeting. I'm always concerned when someone talks about multi-billion-dollar markets and doesn't further segment it. There is no such thing as a multi-billion-dollar market that doesn't have further subsegments to get down to. So here is what you can actually address, and it may be, okay, there's a couple $100 million that are relevant for the product category that you're actually entering into. So don't just hand wave, and say, well, it's a huge market and we're going to get a tiny share. Narrow that down. It's great to know there's a huge market that is adjacent and you could eventually get to, but in terms of your first market launch, the first MVP that you launch may be relevant to, a much smaller segment. Just be clear about that. Just be, open and honest about that. Investors can quickly smell out when, someone's blowing smoke in their eyes. That's what they do. And they see it all the time because, and so they want to read through that, and to build up your credibility and to retain your credibility as an entrepreneur, you want to always be open and transparent with the people you're talking to and share with them, here is the actual story. Here's what we're going to address today. And with, Rev 2 of our MVP and Rev 3, we'll be able to expand to adjacent markets. But, here's where we are today, and here's the market potential we see long-term. And then once you've identified, here's the market that you can serve, we look at how compelling is your value proposition. If growers today are spending $100 on something in your category out of the $20,000 they're going to spend to grow, 40 acres of this crop, your value proposition is affecting less than 1% of their total costs. They just may not care. They may not care enough to switch from what they're doing today, which may be a do nothing, or maybe just working with an established provider of some modest value proposition. And your value proposition might be really compelling, but it's just not big enough for them. We use the phrase, is it a bleeding from the neck issue? I've got to stop the blood now because my survival is at risk. A grower who's got a survival at risk question is going to be willing to spend money with an untested new supplier that doesn't have 5 years experience in the industry. If it's, I've got a pinprick on my finger, but it doesn't matter. Yeah. They're probably not willing to stretch and take a risk on a new untested supplier. So you've got to find those really compelling value propositions. They're going to cause your customer base to take action. And then we start to pay attention. Oh, you've got something that growers representing $100 million worth of produce need to do this year because there's a regulatory imperative that they do something this year. Or, with COVID-19 and the labor situation, they're going to really be eager to try out, your new widget. Now you've got our attention. So it's the strength of the value proposition and, multiplied by the size of the market that helps us understand, there's probably sufficient opportunity for traction that it's worth listening more. And then the next step for the entrepreneur is to demonstrate that traction.
Yeah.
From an angel perspective, we love it where, we see a couple of different risks as investors. The risk is the technology may not work. Or once you get past that, okay, the technology works, but the customer doesn't care. Both of those are equally fatal. And we love to see entrepreneurs at the point where they've got at least a minimum viable product or a prototype to demonstrate that the technology works. And they've got 4 or 5 customers who are doing pilots or alphas or whatever that demonstrate, yeah, there's customers that actually care and are excited about your value proposition. It's compelling enough for them to actually, want to be quoted as saying, yeah, I think, Joe or Cindy's technology really, is great. That eliminates technology risk and the market risk, at least so far as there's somebody who cares about a technology that actually works. Now it's up to the entrepreneur to demonstrate beyond that and convince us that it's going to be something that's sustainable long term. We've got lots of other questions that we'll come back with, but that's the point where angel investors love to get in. It's harder for entrepreneurs to engage angel investors earlier than that, and yet I know it takes money to get to a minimum viable product. It takes money to be able to recruit 5 customers for a beta or an alpha test of a prototype. It's more difficult to engage investors early on unless they really have a compelling belief in your technology or in the size of the market. That's what I find what's interesting for entrepreneurs here in the Central Valley is there are investors in the Central Valley. They're in Fresno with the Central Valley Angel Group, with the San Joaquin Angels in the Stockton Modesto area, with the Sacramento Angels, even the North Bay Angels in the Sonoma Napa area. There are investors that do understand the agricultural community, and they do understand grower needs, and they might be willing to take an earlier risk on a technology because they say this is really compelling. I believe the market exists if your value proposition carries through. And of course, in the Bay Area, there's a number of angel investors and venture firms that are now starting to focus on ag and food technology. That wasn't the case back in 2012, but it's becoming more and more relevant with groups like AgFunder and others really promoting the ag and food technology space.
So just speaking, and I think you bring up a good point there, that the trend is we're seeing more investors that are familiar with the space, and that's continuing to grow. But I think we could agree that there's still plenty of angels and early stage investors that just aren't familiar with the market. So if we took a startup that was looking to raise money from angels that maybe weren't as familiar, what are some of the key data points just from any industry perspective that you're going to want to see to create some level of familiarity with what you would be getting into as an investor?
Well, that's where the articles that we put together, the first one specifically, which talked about markets, being able to visualize the market that you're attacking as an entrepreneur with your technology, identify the size of that market and the adjacent markets. Investors are not reluctant to be educated about markets and segments they haven't heard about. I think one of the challenges in the ag tech space is so many investors are unfamiliar with it, and they're more than willing to have the entrepreneur spend their time educating them about the market, but they may actually never invest. What we see is for every entrepreneur who gets funded, there's typically a lead investor, and that lead investor typically does in fact have an understanding of the segment they're investing in, has confidence. And by having a lead investor, you can find follow-on investors or who will co-invest in the same round, but they'll look to that lead and they'll say, if so-and-so thinks that this is a valid proposal and they're willing to step up with investment, I'll put some money in as well. Perhaps not as much, but you might have one lead and 5 investors follow, and together you've fleshed out the round. But in this space, I think entrepreneurs have to be willing to do some primary education about the market, about who the key players are, about what are the exit opportunities. Money has been made by investors and startups in the ag tech space, and more money will be made, but you might have to educate your investor community about those opportunities.
So I know in the article, John, we talk a lot about kind of the macro research and making sure that the market size is there and the segmentation. Is there any micro research that you would add to that, such as customer interviews or anything else to where it's more of the startup gathering firsthand data gathering that you would like to see in addition?
As an investor, I think customer stories are very compelling. Having the entrepreneur, being able to relate. I talked to these growers, and here are 5 major growers here in California that have this compelling problem that I've solved. They have, reviewed the solution that I'm proposing or that I've delivered. Even better, they're trying it out right now in their fields and are looking to expand their use of it next year. I mean, those are the kind of compelling micro testimonials, micro examples that complement the macro. Here's the market size, and here's validation that these customers who represent that larger market really find my solution compelling. And in an investor pitch, the 5 or 10 minute pitch, we're going to have to rely on the entrepreneur, asserting that that is the case, and then follow on due diligence that investors do. They might want to actually talk to those customers. Those examples that were quoted in the testimonials, let me talk to, Farmer Sally or Farmer Joe, and talk to them about, how broad is the nature of their pain, their issue that this particular solution solves. How great is the potential for increased yield or growth or reduced crop losses if this solution really works the way you claim it'll work. Investors will often want to do that due diligence, but the entrepreneur walking in, having those names, having talked to those real live customers, having asked them, do you mind if I use your name, and would you be willing to talk to others about your belief about this solution? If the entrepreneur has done that due diligence up front and is able to relate that, then investors really value that. Investors don't want to go out and have to find customers themselves that think this solution is useful. They may talk to their friends or acquaintances that they have, but if they have to dig hard to find a customer who cares, they're not. That entrepreneur will not be successful raising money from that investor.
Yeah, sure. So, just transitioning a little bit more to the strategic partnership side of things. I know you mentioned a great way to learn more is reading through 10Ks, just what the company's goals and objectives are. Now, as an entrepreneur wants to progress maybe further in, hey, we've identified in their strategy, this company, they're looking to go in this direction that our technology can solve. Or you take a private company where they may not have that information, but the next step would be having a conversation with that company. If an entrepreneur is able to get someone from that company, a strategic partner, on the phone, what are some of the qualifying questions to take their data gathering to the next level that you would find valuable as far as what they're seeing, what they're gathering from this customer? What type of information should they be looking for in those conversations with those strategic partners?
Well, let's break the strategic partnership opportunity down into a couple of different segments. There might be major either national or global companies that are suppliers to your segment. And the relationship that a startup company might have with one of those early companies as a supplier is of a certain nature. It may be different if that major global, national or global company is a potential customer for the technology. Is it a sell transaction to that partner, or is it a purchase transaction? Or are they a collaborator? We're working with a startup company now in the Sacramento region who is providing something that enhances the ability of biological crop protection companies that are supplying beneficial nematodes. That's a category in the biological crop protection space, and there are major first tier and second tier global crop protection companies that provide nematodes, beneficial nematodes, as a product to their customers. This startup company in Sacramento region has an adjuvant, basically something that complements that and increases the effectiveness of that product. And so they're not necessarily customers, they could be collaborators, or both delivering into the channel these two products, so that the nematodes and this pheromone-based adjuvant together enhance the effectiveness in protecting crops. So depending on whether the nature is we're going to sell into the channel together, or I will, you're potentially a customer for what I'm selling, or maybe you're a customer, you'll buy it, you'll integrate it with your product, and then you'll sell that onto global customers through your channels. The nature of that relationship, each entrepreneur should understand for each strategic partner, what are the kind of initial potential structure of the relationship, and they're not all the same. I was on a call earlier this week. It was a AgTech conference that was being broadcast over the web, and one of the startups was talking about their product, which was an allergen-free consumer packaged goods. It was packaged cookies, And they were using, today they were using for production, co-packer who had an allergen-free facility, I believe in Idaho or Utah or someplace. And they started talking about the strategic partners that they might seek as potential acquirers in the future. And they got very specific. They said, there's many different consumer packaged goods companies. They're all very concerned about these new emerging segments, trending food brands, which are allergen-free, et cetera. But Mondelez, which is a company that spun out of Heinz and Kraft years ago, there's now been a fragmentation in that space, and they're re-emerging and reacquiring. But Mondelez, this entrepreneur said, already has an allergen-free production facility. They have some allergen-free brands today. Those brands are relatively weak brands, and we're out competing them in stores like Whole Foods and Sprouts. And I may not have the the details. They really understood who the strategic potential acquirers were that already had facilities that could produce their product, who had weak brands that might be willing to acquire a new brand to supplement their existing, less than competitive brands. And they said, yeah, there's other companies like Kraft or Campbell's that might also be, interested. But again, they understood that some strategic partners didn't already have strategic investments in that allergen-free facility, would have had to do, more work basically to integrate their particular solution approach. That gives you a sense they've done their homework. They have enumerated who the key players are. They know which ones are strategically positioned more close to their particular technology. I would also caution entrepreneurs not to be too selective in which strategic partners they work with. There might be, one that's the key partner I'd love to partner with. But you never want to have only one acquirer. At the end of the day, both you and your investors want to have an auction environment with as many potential acquirers vying for your attention as possible. There is very clearly a fear of missing out if 3 or 4 strategic players are looking at your technology as really making a difference for them and their business. It supplements their product line in a key category they don't want to be missing out on. And they see that one of their competitors might actually scoop you up, and you might have already had 3 testing agreements or joint marketing relationships with one of those potential acquirers, but this 3rd or 4th one says, I see this key technology being acquired by my competitor. I'm gonna have to compete with that competitor now. That's the last thing I want, and they might bid. They might actually bid more for your company as a way to ensure that you don't fall into one of their key competitors' hands. So understanding that competitive dynamic among the strategic players, you're just maybe a bit player at this moment, but you could become, you'd love to be a pawn being competed for by 2 major global strategics. That's where you get valuations, 100 times your current revenue. If you're eventually going to be selling out to a financial investor, it might be 3x your annual revenue in terms of valuation. If it's a strategic partner that wants your brand because you've been taking share from them in their key, grocery channels or whatever, and the last thing they want is to have you fall into the hands of one of their competitors, they're willing to pay not 3x, they're willing to pay 10, 20, 100x. Yeah. And that's where you as an entrepreneur make money. That's where your investors make money. And that's what pays for all the time, blood, sweat, and tears and sweat equity that you put into your business. So it's important to capture all of the potential strategics, the ones that you might feel would be natural and comfortable to do relationships with, and also the ones that you feel might be more distant, more awkward. Maybe one headquartered in Europe and not here in California, but maybe that European strategic wants to make an entry into this category in North America, and they might see your company as their platform for doing that. Someone articulated to me once, the role for every entrepreneur is to build the closest strategic, the non-exclusive, you want to be the closest non-exclusive partner with every strategic company in your segment that you can afford the time and effort to build relationships with. If you're going to do a market test with one of the strategic players in your industry, you can also do a market test with 2 or 3 other strategic players in your industry. And you just might happen to let them know, by the way, you're partnering to do a market test with one of their competitors. Again, the fear of missing out on those players' behalf is a very powerful motivator. And the last thing they want to do is have their boss turn and say, hey, you know, our competitor just acquired company X. Weren't you doing testing with company X? Why didn't you let us know that they were, you know, potentially being acquired? Or, you know, that investment round, why didn't you let us know that they were doing an investment round? Because we could have invested. And instead, you know, one of our competitors stepped up and put $20 million and is on the board of that company. You know, again, that fear of missing out is a powerful motivator in large organizations, and nobody wants to explain to their boss why they missed that opportunity to partner with you.
And John, this is
a play those dynamics against each other. I mean, as a startup entrepreneur, you don't really have that much strategic leverage, but the fear of missing out gives you leverage far more than you sense. You know, I worked for both AT&T and for Hewlett Packard, and we made a number of acquisitions in the business units that I was part of. We bought 2 or 3 different wireless companies while I was there, and networking industries. And again, the fear of missing out, none of those were necessarily competitive bidding deals by the time we got down to it, but you know, there were a number of different technology acquisitions where you know, one player is basically trying to outbid another player, and it goes back and forth several times.
And this may be a simplistic question, John, but when you have a company come to you and they say, here's our market, we're talking strategic partnerships, how do you view a plan or anything along the lines to have these strategic partners actually participate in the rounds? Any suggestions or thoughts on that for entrepreneurs that are trying to consider that, if there's any participation or researching to see if a company would even be interested in participating in a round?
So surprisingly, a very large number of companies in the food and ag space, large global national companies, have investment arms. Bayer, Monsanto had a venture arm before they were acquired by Bayer. Bayer had strategic relationships with 2 or 3 independent venture funds that they were a significant limited partner in those funds, and those venture firms were focused on the food and ag space. Syngenta has a venture arm. Corteva has a venture farm. Companies like Cargill, even distributors in the food and ag space. John Deere has a venture arm. Even some of John Deere's competitors have. In the water space, both Valmont and some of the other players have made acquisitions and have venture arms. Almost every significant player in the ag space is conscious of the fact that technology is going to transform the ag and food space. They're conscious of the need for technology to transform our current practices and efficiencies in the ag and food space just to keep everyone competitive. And they're all looking at how can they participate either in joint testing, in being aware of those companies, and in some cases making capital investments. Now, as an entrepreneur, you might want to be thoughtful about actually taking money from one of the strategic partners in your segment. Again, when I say thoughtful, I'm not saying don't do it. I'm not saying run to any and all with open arms. I'm saying be thoughtful. If you can get capital from financial investors who are not connected with your industry, I would say that would be ideal, because that leaves you untainted. I mentioned this fear of missing out. You know, for example, if you had a member of the Syngenta Ventures team, Syngenta being a large player in the crop protection space, on your board of directors, reviewing every one of your strategic relationships, and you approach Corteva, for example, another competitor in the crop protection space, and you want to do some joint testing with Corteva, and the specific Corteva products that you're going to do joint testing with will be known to members of your board, which includes this representative from Syngenta. I mean, it just creates this reluctance, this hesitation on the part of some of your potential strategic partners that they may not want to do business with. When you say, I've got a member from, you know, Moneta Ventures and XYZ, on my board, they're all financial investors. They have no particular strategic axe to grind. They're not associated or affiliated with any of the, other competitors. Then strategics have no hesitation at all. It's great. You've got capital. Let's go and do some joint testing. Let's do some joint go-to-market exercises or something. There's no hesitation. So just be conscious of, if you do have a relationship on a financial or a governance level with one of the strategics in your industry, that may cause hesitation or thoughtfulness on the part of other strategic partners. And again, your mission as an entrepreneur is to have the greatest number of non-exclusive relationships you can with strategics in your segment. So anything that limits your ability to have the greatest number of strategic relationships or alliances or testing agreements or other things, that's something you should, again, be thoughtful of. If that's the only capital available, or if that capital enables you to do something very meaningful in terms of partnership with that strategic company, then absolutely do it. And many successful companies have had strategic alliances and engagements. And I know of a number of different startup companies. Mendel Bio was a company in the Bay Area, in I think Pleasanton or Walnut Creek, that was initially founded and funded by Monsanto through Monsanto Ventures. And after 3 years, they realized that Monsanto was not going to be their acquirer, and they were eventually acquired by Corteva. And so it's possible to have a strategic alliance with one strategic player, a financial engagement with one strategic player in the industry, and then be acquired by another one. But the acquisition value by that other competitor was, I think, somewhat lower, and it was not an auction to the highest bidder. It was a kind of a reverse auction, at a much lower valuation. So again, it's good to be thoughtful. It's good to look at what's the history of other acquisitions in your segment and who the acquirers are. And that was the foundation for the third article in the series, was look at the transactions in your segment. Who are the acquirers? Who are the people who are involved in those transactions? If it's a merger and acquisition, who are the acquirers? If it's a financial transaction, who are the investors? That tells you who are the investors that know and understand your segment. That doesn't necessarily mean they'll invest in your business, because if a venture firm participates or invests in competitor A in a specific segment, they're very reluctant to invest in competitor B in that same segment, because they may in fact be on the board for competitor A, and they don't want to tell competitor A or through their actions, communicate that they're also investing in a direct competitor. And that, from a board standpoint, if they're a member of the board, that's not consistent with their fiduciary responsibilities. So, but at least you'll understand who the venture firms are that have already invested in the segment, and you can take that information to other investors, other venture firms who might compete with those existing ones, and say, you're kind of neck and neck in this space. You claim to be an AgTech investor, and these other investors have already invested in this plant-based protein alternative. I see that you don't have a plant-based protein company in your portfolio, which makes you an eligible investor to invest in our plant-based. And let me tell you why we're actually better than what those other venture firms have been already invested in. That's the kind of conversation. But you can only get into that conversation when you've already cataloged who are the players in my segment, who are the investors, the venture firms and others that invested in that segment, and what are the big names that are missing from people who invest in this segment that I should be talking to about why they may want to also have an investment in the segment, because it's a compelling segment and it's going to go, gangbusters, and they don't want to miss out. You can only have those conversations when you've done that homework.
Sure. And that's why it pays off to do plenty of the research in advance. So I know on the third section, we talked a lot about valuation and exit and kind of projecting out the potential performance of a startup here. One of the things that we've seen, at least on our end, and maybe you have too, is selecting comparables that may or may not be believable. And obviously that's in the eye of the investor, different perspectives there. What are some of the key things that you could recommend to an entrepreneur to make sure that you're selecting companies? And I think you mentioned this a little bit in the article, but if we could expand further, selecting comparables that have a realistic pathway or similarity. We say?
That are truly comparable.
Truly comparable. Exactly. Thank you.
Well, if anyone's ever bought or sold a house or a car, a used car, you realize any specific company, house, or used car is a unique article. And there's always specific nuances around that. So saying, there was a comparable house in a different neighborhood that had larger square footage and sold for more money, that may not necessarily be relevant to your specific home that you're either buying or selling. Any transaction price for your company is going to be unique with a specific willing buyer and a willing seller for your company. But it's good to have some benchmarks. I would be, the key metrics as an investor looking at comparables is, were they at the same stage as your company? If you're a pre-revenue company with high ambitions and you're using as a comparable a company that had already achieved $1 million in annual recurring revenue, et cetera, there's different metrics that are used for pre-revenue companies versus post-revenue companies. If your annual recurring revenue is $1 million and you're using comparable a company that has annual recurring revenue of $100 million, again, the size and scale are very different. So look at level of maturity, stage of company, level of maturity. If you have revenue, what's your revenue run rate versus the comparable? Just like selling homes is often based on dollars per square foot, because every home is a different size, different number of bedrooms and everything else. But when you average it out in terms of dollars per square foot, construction costs and comparables, that's a metric that people use. For startup companies or businesses that are being bought and sold, a metric is enterprise value over revenue, a ratio. It might be 3x revenue. It might be 10x EBITDA, which is earnings before interest, taxes, and amortization. Most startup companies don't have amortization, so it's earnings before interest and taxes, and many companies are not even earning positive operating profit, so they may not be paying taxes. So it might be over gross margin. But there's a number of different ratios. EBITDA is commonly used among existing profitable operating companies. Revenue is used when you don't have that metric. So look at the transactions in your space and look at what is the multiple of revenue. Some companies have gone public, like Beyond Meat. I was looking at them just earlier this week. I think their price earnings ratio is like 3,000 to 1. The average for the S&P 500 is like 18 right now. So, these ratios can vary dramatically depending on, the nature of your business and the speed of your growth. If you're a stable year over year, the same revenue, you're not going to have the same revenue multiple as a company that's been growing 10x every year.
Sure,
because
that
investors are buying ahead. They're looking to buy something today that in 3 years will be worth more. And so if you're growing rapidly, they'll start to maybe pay up a little bit for that growth. If you're not growing, there's nothing to pay for. If they're going to buy a business for $10 million today, and it's going to be worth $10 million 3 years from now, they've got to ask, well, why am I buying this? So, they're going to expect to pay less. Sure. But something that has the potential for rapid growth, Beyond Meat went IPO last year and, at a huge multiple, and we'll see if their growth, matches that. Many other startup companies have been acquired by strategics, not because of their revenue. Many companies are bought even before they have meaningful revenue, because the strategic company says, I've got a hole in my product line. And although this startup might be operating in a very small segment here in the California market, but a company like Bayer or Corteva or Syngenta can put your technology in China, in India, in Australia, or in Europe tomorrow, next year, next growing season. They have the distribution channels to suddenly make it worth far more than what you've actually achieved in the small initial market that you launched in here in California, here in the US. And they can make that multiple very quickly. And that's why strategics are so important. Many of them have the ability to take your product and immediately launch it into global channels, existing channels that they own, channels of distribution for crop protection products, for seeds, for farm equipment and everything else. John Deere, Jane Irrigation, et cetera, Netafim, have global channels. They can immediately launch. They just introduce, hey, we've got this new product we just acquired from company X, and you can sell that into China, India, Australia tomorrow. And that's why the strategics have such potential as partners and acquirers for startup businesses. They see the need for innovation. Entrepreneurs have the innovation.
Yeah.
They have the channels that entrepreneurs are often struggling to try to achieve, even in the US market. So having relationships, go to market, and reseller agreements, joint testing agreements, gives you visibility and gives the entrepreneur experience in, now I understand maybe there's 3 distributors into the Indian market, and Bayer and Corteva have 2 of them, and I know who the name of the 3rd one is. I know who to call now. That entrepreneur might never have learned that if they hadn't been doing testing and chatting with the folks that they're testing with in India through the strategics. You learn a lot. Every relationship you have, suck that relationship dry in terms of market insight, market intelligence, just chatting about, so how do you feel you're positioned against your competitor in this space? Oh, you have a gap and that's why you're doing the testing with us. File that away in the back of your head so you can pull that card out later when it comes down to an investment or an acquisition or a partnership discussion later. You can say, I hear you have a competitive gap competing against company X in this category, and our solution, our technology, our product can help fill out that gap in your portfolio. Now the entrepreneur has strategic leverage that they would never have guessed that they had if they hadn't been doing that, intelligence work.
Sure thing. So
we're getting way off the track of the
no,
line
that's
of
fine.
questions. I hope it's useful.
Point. No, of course. I just want to tell everyone here, if you have any questions, let's put them in. We've got a few minutes left. I've got one here. Let's see what we can get out of it. It says, what happened with companies that are generating a recurring revenue above $1 million, like service providers with long-term contracts? I don't know how to necessarily interpret that. Do you have any stab at that, John?
Well, if your startup company is generating $1 million with long-term contracts, that's a very solid, stable platform base. How can you grow that? And there's 3 ways to grow that. If you've got customers that have long-term contracts, they must like what you do. Do those customers have additional customers? They can help refer you to those additional customers to build additional contracts. Can you build a deeper relationship with that existing customer who's satisfied? You might have $1 million recurring revenue in terms of long-term contracts, but can you expand that to additional uses within their organization? If it's a global organization and they might be buying $100 million of that product category across their global enterprise, and $1 million of that $100 million demand is satisfied by yours, but can you expand yours to $3 million, $5 million within that existing customer? And the third way to expand your business is, are there adjacent services? The wonderful thing about services is often it is can grow incrementally. Oh, I've got this one service providing, data intelligence about, water use or whatever to this customer. How is the customer using that data? And are there adjacent services? I can maybe integrate that data with other data. So I'm providing the base service, but I'm also enhancing it, embellishing it, adding additional value to now have a second contract for $1 million recurring revenue, to have that second level of, maybe I got my MVP and then I've got my add-on, the +1 in the MVP. And by exploring that +1, I discover 2 or 3 more, +2, 3, and 4. Now I've got $4 million a year recurring revenue with that customer. So whenever you've got a good, solid relationship, that's gold. How can you get more customers, have referrals from that one satisfied customer to their other, adjacent players? If it's to growers, for example, there's thousands of growers in California. If you've got 5 growers that love your product, each of them know 5 more. How can you get to 20 growers that use your product? How can you deepen the relationship with that existing grower and, capture more of their share of wallet? Again, if they're spending 100x on this category, how can you get more of that 100x than you currently have? And then how can you add adjacent services for those existing customers, new products, new services that are, quick, easy build outs of that initial minimum viable product that you're already, or minimum viable service you're already providing.
And then the person that asked the question, they added in terms of valuation as well, which I think we covered most of that today as far as some of the process, but specifically, I guess with the recurring revenue component of $1 million, I think he may be looking for the financial comparison.
So if you have $1 million of recurring revenue and you're generating, let's say, 10% operating margin, I mean, I'm just picking numbers.
Sure.
10% operating margin on $1 million is $100,000 a year. If current financing rates, a capitalization rate, if an investor wants to get a 10% return on that, let's say you have $1 million recurring revenue, long-term, contract for 10 years, and that's all. You've got basically a stream of cash flows over 10 years of $100,000 of operating profit times 10. That's worth about $1 million.
Total.
And if someone's trying to get a 10% return, they're going to discount that 9th and 10th year by 10%. So, it's probably worth to them about $800,000 of cash right now to buy a business that's generating $1 million of recurring revenue for the next 10 years at 10% operating profit. That's called the discounted cash flow analysis. That's one of the ways of valuing your business. Hopefully, your business is worth more than just, a non-growing, stable, recurring revenue stream. If you've got that, I hope you're using that $100,000 of operating profit to invest in, again, finding more customers, building more services to expand your share of wallet within an existing customer, or both, and growing that $100 million of recurring revenue to $2 or $3 million next year, to $5 to $6 million in year 3. That now is a growing revenue stream, and the discounted cash flow analysis on a growing revenue stream at X% profit is worth far, far more.
Well, and John, wouldn't you say that that's the difference between a financial investor or acquirer versus a strategic investor or acquirer?
Absolutely. The discounted cash flow is something that is only used by financial acquirers. You might find a strategic trying to negotiate with you as an entrepreneur using discounted cash flow, pretending as if they were a financial investor. That's a floor. That's the bottom of what they might be willing to invest. The top of what they might be willing to invest is, what's it worth to them in terms of their business. Use the analogy if Syngenta is competing with Bayer in a crop protection space that's worth $30 billion, and the specific segment that you can enable, Bayer and Syngenta are competing head to head over, a $5 billion biologics segment. And the difference between your little tiny, $10 million business, $10 million revenue business that will enable one player or the other to capture more of this $5 billion segment, that's worth far more than discounted cash flow on that $10 million business. It could be worth billions. When AgriQuest, which was a small biological products producer in the Sacramento region, was purchased by Bayer and established Bayer Crop Sciences presence in California from a crop protection space. That acquisition was a $500 million acquisition. It happened back in 2014. It was one of the earliest acquisitions in the ag technology space. I think that AgriQuest's net revenue was probably 5 million, and they sold for 500 million. 5 million or less. I think they might have had approved products, but I think they had just barely, launched them. The revenue was not what Bayer was buying. Bayer was buying the science and an early, buying a ticket on a roller coaster ride, and they wanted to be an early acquirer and have a presence in that space. And so it was 100 times or more whatever revenue AgriQuest might have had at the time. And I don't have any, confidential or proprietary information there. They were a very early player in a very early market and did not have a significant revenue. So the strategics paid far, far more than what any discounted cash flow analysis would have. And I'm certain that AgriQuest was by no means profitable at that time. They had just launched their products. They were probably spending far more in R&D than they were ever making in terms of just gross revenue. But happy, willing acquirer was happy to buy them at that price because it gave them that category in their portfolio, and they've now, based a large Bayer has made 2 large additional acquisitions in the biologic space, but I believe that was one of their first and established their presence in the category.
Well, John, thanks for giving us that overview there of the article, expanding upon it further. I know there's a lot of great information. For those of you that haven't read the articles, I'll drop the link in the chat here. Make sure to check those out. That'll help not only with the strategy of your company, communicating with investors, planning out who to contact, why you're contacting. I think we've got a great process there captured in those articles, John. Any
Yeah, the
closing
articles,
comments?
just quickly, if someone can't find the articles, look at our website at www.agstart.org under our resources page. And we're happy to provide services. We collaborate very closely with Blue Tech Valley and the Wet Center. We're part of a collaborative network across California. We are happy to provide mentorship to Blue Tech Valley participants. We have a monthly office hours, which you can find on our website as well under events. So, let us know how we can help. And I wish all of the entrepreneurs in whatever category that you're competing in all the best. We're here to help. We still have time for more questions, or you can email Benjamin after the event, and we'll try to get your questions answered one way or another.
Excellent. Well, let's do this. If you have any questions, feel free to shoot me an email. John, I know that I'd recommend to anyone here to connect with AgStart. If you're in the ag space, I don't see any reason why you definitely should not be doing that. And in addition, next week we'll be covering sales with Dale Bierce, rebuilding your pipeline in 90 days. So for the leads that have gone cold, and then the fact that you may have not been able to do any prospecting as of late, we'll be discussing as things start to kind of fire back up and get moving again, the steps you can take to rebuild your pipeline again. So that'll be next week. And again, check out agstart.org. I have the link in the chat there for articles. John, thank you for your time.
Thank you, Ben. I really appreciate it.
All right. Take care, everyone.